Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in. Let's take a look and see what people are sharing. If you want to follow me, it's at Finding_Finance. And if you want to join our community, you can join. I just released a midweek update for everyone in the community. That is where I go over all of the potential investment opportunities that are out there. And right now, we have an insane amount of opportunities, in my opinion, with technical chart setups, with very good companies paying over 10 to 20% dividend yields that are good entry points at this time. So this is a midweek update that at least I would want to catch. If you're interested in joining, you can use a May Day coupon code, MAYDAY. It's in the description link below. You get 50% off the first month only on a monthly membership, and you get a larger discount on the yearly membership. All right, so coming down, only uranium. I think he follows me too, but I saw someone post this. He says, I can't say without any doubt in my mind that investing in uranium has been not only the worst financial decision, but the worst of all decisions I have and probably will take in my life. Suffering mode, not screenshots today. This uranium community deserves pain for arrogance. I don't know if I agree with all of that, but I will say this, guys. Some of the things that you want to evaluate in your investments that I haven't really talked about this too much, even on the website, but there are investments that are a lot easier to hold than others. And it's due to the volatility and the emotional turmoil that people go through while they hold their investments. Uranium has a lot of volatility. And I'm not saying that other sectors don't have volatility, but it has a lot of volatility. And there's a lot of whatever investment you go through, there's going to be volatility. In commodities, there's a lot more volatility in commodities than other sectors. But if you want to get decades of returns in a few years, you have to put up with the volatility. That volatility generally comes from higher cost producers, developers, or explorers that are highly linked to the commodity price. When you're in the early stages of a bull market, you do a lot of sideways grinding. The early stages, when you transition from wave one to wave two is generally a big grinding phase. It grinds people out. And then the people who have done the homework, who are buying when things are cheap and have the patience, is where they're going to be rewarded with decades of returns in only a few years, 5 years, 6 years. Um, that's where a lot of the returns come from. It's from the patience. And I understand and I'm empathetic to a lot of people's viewpoint here, saying how frustrated they are. But really, what you're frustrated with is that you have a time frame that you put in your own mind, and you are measuring the success against the time frame that you fictitiously chose. You can go back into history, you can look at all of these commodity bull markets, especially the beginnings of them. What you get is you get a wave one move with a big wave two pullback. And a lot of the commodity sector is in that wave two pullback or slightly after wave two pullback. How do I know that? It's based off of the chart patterns that I'm seeing. And I know a lot of people probably don't know how to read charts from a technical analysis viewpoint. And I think that's probably where a lot of frustration comes from. A lot of people who have joined the website, I'm not trying to plug my website. I'm just trying to tell you what people experience. There's a lot of people that have joined. They may or may not be experienced in the markets. And I go through these companies over and over and over. The ones that I think will do incredibly well, I look at the charts, I get them seeing and talking to the charts, and you can see these patterns, and they repeat over and over. And when you get these patterns, it gives you confidence that what comes next is that move. Now, I can't I can't expedite someone's learning process to zero, 0 days, 0 hours. It does take time. It does take repetitiveness. It takes looking at charts over and over, and then you get comfortable, and then you start to figure out how to play the game, and that's where the value is. Because once you figure out how to play the game, you become aggressive when you need to. You pull back knowing that after a 20, 30, 40, 50, 60, 100% run in a stock, we could get a pullback. And you learn that push, pull, take. You take it when it's low and you just let it go. You let it run and you don't want to add and FOMO into the stock. I have a feeling that a lot of people in uranium did a lot of FOMOing because they're retail investors and they're newer investors. And that's perfectly normal for newer investors to FOMO into things. And then the frustration comes because it's not working out in the time frame that you want. You're seeing that your account is down in the short term, and all of that occurs. So here's another thing to evaluate. Look at the volatility of some of these stocks. There are certain sectors, in my opinion, that can do as good or better as uranium, and it will be more stable. It'll have less volatility. So it might be an easier ride. You get all of the upside benefits that uranium would give without all of the volatility. Now, that's not 100%, it's not going to be 100% of the time, but that's what we're looking for. We want to reduce that volatility, make it a little bit easier ride. And I'm here to help you guys find those opportunities. The problem is it's not located in uranium. It's located in other areas. Now, that doesn't mean that you're immune and then it's just going to go straight up. You're still going to have volatility. You might not have as bad of volatility. So that's what you have to manage. Your emotions and then finding opportunities that you can live and deal with. And then learning the game. Learning that game is so important. Mining visuals, gold and house prices, 1984 to 2024. This is part of our collaboration with IGWT report. So blue is the median house price, gold price is the yellow. Obviously, there's a large disconnect between gold and house prices into the year 2000. And then you can see the year 2000, we had a monster move. And then we pulled on back. It was undervalued 2015, 2016. And here we are ripping again. Now, the question that I have is, do you think house prices are going to follow this way up? Or are we going to have this decline that people are talking about on YouTube, which I disagree with, but I think house prices are going to go up. And the reason is because they're devaluing the currency. It's all about the currency, guys, the denominator of what we're looking at. And that currency devaluation is where everything goes up in. Gold's going up because of currency devaluation. And when the market conditions are right for gold to go up under, it accounts for the currency units. It doesn't account for it every single time frame. The market conditions need to be right for it to account for it. And right now, we're very undervalued for gold. Still, in relationship to M2 money supply, Dow Jones, S&P 500, NASDAQ, and a whole bunch of other asset classes. Alfonso says, I think a major catch-up trade is brewing here, and copper can kick it off with a move above $5 a pound. Gold's already broken out. That's our leader. There's your cup and handle. And look what we have here. Cup and handle, ready to break out here. It's got the same fractal overlay as gold. So what do you think the probability of copper is going up? Probably pretty stinking high. We're right at resistance. It may take some time. That's where the patience comes in. The patience comes in because these things don't occur overnight or over weeks, and sometimes it takes months and years to play out to the expectations that people put on it, the fictitious expectations that people put on it. Now, this thing looks prime for copper. It looks prime, ready to go. Gold's already done it. If gold's our leader and we've got a similar fractal that looks prime and ready to go, that is your probability of success. That's all you get in the market. It's not going to give you a green light and tell you that, this is occurring. It doesn't tell you that. It's in the patterns. The patterns gives you the statistical probability outcome that is favorable. And that's all you get. You do not get 100%. You only get a favorable outcome. And then the more you can stack of favorable outcomes on top of each other, maybe it's the market conditions, maybe it's the ratio of copper being cheap, maybe it's commodity to equity ratio, and you stack and stack and stack and stack, and then you get good patterns too. That's as favorable as you can get in the market, period, bar none. That's when you go big. And that's all you have. There's nothing that you can get that's 100%. You can only stack these things on top of each other that are all favorable. And it looks very favorable right now for copper to increase. Gold's already going up. I even think it looks favorable in other sectors. I see patterns all over the place that look absolutely excellent in commodities. And they're not small patterns, guys. They're big ones. And big patterns lead to big moves. So I'll share those patterns and those big moves in the midweek update that we've got being released today. Steve Millionaire Habits, he says, if you can't cover $1,000 emergency from your savings, then you can't afford to go out to eat. Yeah, I would agree with that. Now, your emergency savings, you should have not just emergency savings, but you should have a few, 6, 7 months of savings in case you lose your job. Now, that highly depends on your cash flow and the diversity of the cash flow that you have. So you need to measure the risk of cash flow loss versus how much savings you need in your account. So if I have $100,000 and it's coming from a single source, and then you look at your expenses, you need a lot more savings because you can lose the single source of income. What I've done is I have a lot of different forms of income. If I have 10 different forms of income and you make, let's just say, the same $100,000 income, but it's from 10 different sources, and you lose one source of income, it may not even matter. Your robustness or your, I'll call it resiliency to problems in the market or problems in the world goes up as you increase the number of income sources. And the whole goal is to become resilient enough and have enough sources of income where it doesn't really matter if you lose one or two of them. That is like the sweet spot if you can get there. And what are those sources of income? Well, you can get dividend yields, and then it'll snowball through that dividend snowball effect. I am playing that in my Roth 401k that I'm sharing on the website. I'm also doing that in my individual account. And I'm snowballing it, and I can live off of those dividends. Now, some people will say it takes a long time to save up. Guys, that's just the stage that you're at. It does take time. And you know what? I went through it. I am in my early 40s, and I started it in my 20s. When I first started working at 22, 23, 24, when I started going through all that, yeah, I was saving everything I could. I was sacrificing consumption of crap and putting it in for my future 40-year-old self. Now that I'm my age, I get to reap the rewards of all of those savings with a big fat dividend payment throughout the year. And there's companies that pay me monthly. There's companies that pay me quarterly. There's companies that pay me almost every other month, and they've got different dividend schedules. And then I reinvest those dividends because I can, and I grow the dividend income. And that's how you do it. Now, if you're struggling to cover or don't have an emergency savings or have savings where if you lose your job, you can't float yourself for 4, 5, 6, 7 months. I mean, that is stage one, guys. As you gain these savings and as you build your investment portfolio and as you build your income streams, that is where resiliency comes in play. And that's also a huge peace of mind. It's almost like you have all the weight of the world lifted off you. And you can just take whatever comes at you. A $10,000 bill. Granted, it's very rare to have a $10,000 problem. You'll just shrug it off. You're like, yeah, whatever. It's not a big deal. I need new windows on the house. Not a big deal. And that's where things get real fun in life. Here is the top 12 biggest wastes of money, according to Mark Palmer. Driving too fast. I guess you consume more fuel and you can get tickets. Mortgage insurance, premium gas, tobacco, extended warranties, lottery tickets, unused subscription memberships, food delivery, credit card interest, payday loans, strip clubs, donating to presidential candidates. The one thing I will say, if your car needs premium gas, run premium gas. That is something that would not be a waste of money if your car does require premium gas. There's other things that are wastes of money that are probably bigger than all of that. Buying expensive new cars, that's a waste of money. Why? You pay higher insurance for them. You pay more for the car itself. It depreciates. It is subjected to damage, whether it's weather related or other people putting door dings or whatever in it. Then you have to pay higher registration costs and everything like that. So that's one thing that I think is a big waste of money because it's way more expensive than all of these small things, and it just keeps piling on. Let's keep going. We've got Bitcoin Teddy. Imagine working a 9 to 5 for 50 years, then the Fed prints 40% of the total money supply and inflates away 20 years worth of your work. Yeah, that's why you need assets. That's why you need to learn the game in order to survive. Because if you don't learn the game and you just hold your money in currency units, I mean, you're going to get inflated away. And right now, inflation is running rapid. So, how do you play the game? What do you invest in? How come I'm in those dividend paying stocks? Because the income in the dividend paying stocks go up with what they charge for their products in the commodities they sell. That means my income goes up with inflation. Oh, this guy's got it figured out. To some degree, I do. Not all of it, but to some degree, yeah. And that's why I'm in those dividend paying stocks. If I need more income, I can hit that. My resiliency goes up, not down. Brandon says, don't look now, but copper's forming a large continuation head and shoulders pattern on the monthly time frame. It's not necessarily head and shoulders, it's that fractal that we see. I don't call it head and shoulders. Head and shoulders are bottoming or topping patterns. This is a continuation pattern. And it's the same fractal that we saw up here with gold and copper. Lindsay says, it's not normal for 20-year-olds to live in apartments. It's not normal for people to take international trips every year. It's not normal to make six figures at the start of your career. Dreams and goals, but don't let social media convince you that working a 9 to 5, saving and investing your money, or picking up side jobs is lame or wrong. If you're in your 20s or 30s and you're still in the building phase, I'm here to tell you that that's okay. I am too 100%. Guys, I didn't start at 100,000 bucks. I think I started at 52,000 back. 50 something thousand dollars is what I started at in 2004. And I saved everything I could. I saved everything. Now, did that mean that I had to sacrifice some things in my life? I didn't feel like I sacrificed much of anything. I enjoyed saving that money for my future self. That means that I cared so much for myself and my future self that I saved all of that money because I wanted to provide opportunities and options for my future self. So, yeah, it's not normal to have this immaculate, um, we'll call it an immaculate place that you rent when you're just came out of college or you just went on your own out of high school. That's not normal. It's not normal to take trips. It's not normal to do and spend all these things and drive $100,000 car when you're in your early 20s. That isn't normal. I still don't drive expensive cars. Why? Because it's a freaking waste of money. It's a waste of money that provides me less options in the future. Now, if I make so much money, if I have 10 or 20 million or $100 million, then I don't see the reason why not to. But if you're at a million, 2 million, 3 million, 4 million, you're still not at ridiculously, you're not at ridiculous levels yet. And some people may think that's ridiculous. That's probably the mindset that you don't. So it's probably just a difference in mindset, is what I'll say. My mindset is when I don't, when I'm under 10 million or 20 million bucks, I'm not there yet. Now, when I get there, I don't know if my mindset will change or not, but I'll just say that maybe I will try to reverse some of my saving habits and try to spend a little bit. But a million, 2 million, 3 million, $4 million, I mean, it's a lot, but it's not. It's like you're emerging out of the middle class into an upper class. And I know that might seem weird, but you still, depending on if you have everything paid off or not, you still have some room to go, in my opinion, depending on how old you are. You're not gonna, if you're retiring at 60, then yeah, or 70, then yeah, a million, $2 million is probably just fine. But if you're retiring at 40 years old, you're gonna need more than, you need more cushion than a few $1 million. So start it when you're young, compound this stuff. There's a couple of things that I think are the most important things to learn if you want to generate wealth. Number one, you need to start early if you can. Number two, save as much as you possibly can when it's early. And number three, you need to learn the game as fast as possible. The quicker and the faster you compound the money, the more it grows. And the more addictive that you will get to investing money. So the better you get at this game, the earlier, the more you will put into it because you can see the progress. And I know some people, they've mentioned it on the Discord channel, that all they want to do is invest the money. They want to work longer. They want to work another job. They want to work overtime so that they can invest and put this money to work in the opportunities that we're seeing. And it's addictive, guys. When you get good at it, it becomes addictive because you get to see the progress. And that progress is not limited, it's unlimited. It's unlimited in potential. Isabel Net, the probability of a US recession in 12 months calculated from the yield curve stands at 43.2% in October. That's the current level of a potential recession given the yield curve. Each says Dave Ramsey hates debt. Robert Kiyosaki said, he loves debt. Which investor do you agree with? I would say that Dave Ramsey is probably closer to being right. But it doesn't mean that all debt is bad. But I do think that you don't want debt. When you leverage way up with a lot of debt, it brings a lot of risk. So risk as an investor is something that you need to manage. And if you get enough debt, depending on the personality type, and I'm one of those people that doesn't like debt, it could have a negative impact on you. It can have a negative impact. So I'm closer to the Dave Ramsey mindset than the Robert Kiyosaki. But under the Robert Kiyosaki, you can get richer quicker. That is true. You can also blow up. You can blow everything up and go to zero or negative. Rock bottom entries. We've got copper as one of the cleanest setups in the commodity space right now, looking fantastic. And more evidence of more people seeing the copper setup. Is the NASDAQ futures chart forming a wedge retest of the July highs? Thoughts in terms of a bearish setup where we could go down in the NASDAQ? That looks like it to me. It looks bearish. The best non-asset investments. Thought this was kind of cool. An air fryer. I actually use an air fryer quite a bit. I cook steaks in it. It's pretty awesome. Home gym. I have a home gym. Silk pillows. What I would say is not necessarily silk pillows. It's the pillows that conform to your head. It saves your neck, man. Those pillows are awesome. And I'm not talking about the my pillow or whatever, but there's other pillows that are really, really good. There's also ones that don't heat up as much either. I think those are cool. Quality shoes, whatever. Linen bedding, backyard garden, electric toothbrush. I own an electric toothbrush. Stainless steel cookware, I own that too. Reverse osmosis water filter. I was actually looking at doing this next. A reverse osmosis water filter that filters out all of the fluoride and all that other crap out of the water. So I am looking actually into that. Another thing that's not on here is a really good bed. I'm not saying I'm an expert in beds, but I like the hybrid beds. The hybrid beds are the ones with springs on the bottom, and then the next layer is that like foamish type layer that conforms to your body. And that combination's pretty good. It's like you get support, and then you get enough foam to conform to you, and then you get a good pillow, and that is really good. And remember, we spend a good chunk of our life sleeping. So I do think that spending money on a really good bed and a really good pillow is worth it. And you don't even have to spend that much money, guys. You really don't. There's, I mean, I have a bed. It's Oli Sleep. You can look it up. It's that hybrid model. I actually don't mind it. I think it's really good, and it's better than a lot of the more expensive beds. So from a value perspective and a price perspective, I bought I think a king size bed for oh my goodness, it was not very much money, like $400, $350, when the dollar was strong and the currency was weak. And this was some years ago, and it was on sale too. And that thing's awesome. And you don't that's all you need. And then you have to put it up on a bed stand or whatever it is, one of those bed frames. And it's been awesome. I love that thing. I actually bought a couple of queen size beds too for the house. I love those. I love those beds. Here is the same chart, only cleaner. So what is this? This is the mining companies. The mining companies is the purple at the top, and then the bottom in the blue is your gold divided by the consumer price index. And then you can see the correlation of this. Why is this the case? This just means that gold has been outperforming commodities. Well, it's been outperforming inflation, but inflation is more or less oil and all those other things. So this is broken to the upside. And what this means is this is the margin, the miners' margins. So if this goes up, it means gold's going up faster than inflation, and that's the margins of the miners going on up. So you can see that correlation. between the mining companies and where we're at today and the breakout that we just got here recently. Looks really good for the mining companies to go way up with time. JC says Israel just broke out of this multi-year base to new all-time highs. The Tel Aviv 125 just hit new 52-week highs relative to the German DAX, as well as a new 52-week high relative to the rest of Europe. This isn't getting the attention it deserves, in my opinion, which is great. So Tel Aviv Stock Exchange looks fantastic, breaking to new all-time highs. There's a lot of really good setups in emerging markets. There's a ton. But that's Israel. We're playing Israel's one of Israel's fertilizer companies. Historical camp for gold right now, or historical comp, I should say. Based on breakout to new all-time highs, if gold keeps going to 3,200, 3,300, then mid-1972 is a near perfect comparison. Corrected 14% over 3.5 months and tested 200-day moving average. And this is where he's talking about right here. And that could be where we are located, somewhere in these areas over here, and what's to come of the gold run that we're in. Here's one from Grady, and I'm just going to read this real quick. U.S. federal government interest payments are going ballistic. This is not even parabolic. It is vertical. From COVID lows, everything changed, and technicals anticipated it. Personally, I do not think Washington has raised the debt ceiling 79 times, frequently changed CPI definitions, printed many extra trillions, inflated Fed balance sheet astronomically, etc., just in order to, in the end, start fighting inflation in a real way. That is highly unlikely. Governments change CPI and PPI definitions continuously for many reasons. One of them is trying to protect the present monetary system. One could look at shadow stats, which gives more accurate numbers. But reality is that measuring inflation correctly is actually very difficult when you really look at it. So what's the answer? As I see it, the real measure of true inflation is the expansion of the currency supply. And government interest payments is more or less a function of the expansion of the currency supply. And knowing this, the chart below becomes pretty scary. It shows that the COVID lows was an historical inflection point where the US government interest payments went vertical, literally. Gold always catches up with government debt and currency supply, and gold is now responding. Both gold and silver have broken out hugely and are both now in a resumed bull market. This commodities bull is the largest financial opportunity we will ever have, and the largest financial threat we will ever face. Make sure you get the most out of this bull market. And here it is. This is US government interest payments going vertical. And you can see the breakout, the potential retest, and move. So think about that and what is ahead of us. And we're going to play this as best as we can. I've got so many good setups here. Mike says home sales are up over the last year. Inventory is past peak for the year. Home prices are up 5% versus last year. There's no sign yet of home buyers freaking out over 7% rates, but I grow pessimistic if we roll into 2025 at this level. He's just talking about contracts pending, but we're up 5% in home prices. Jesse's coming out. Silver was slammed again this morning by the banking cartel, making that 9 morning slams in the past 11 trading sessions. If you think that's organic and normal trading, you're seriously delusional or a paid shill. And there's those big hits every single morning. They really don't want this to go up, guys. And whenever they don't want something to go up, that's exactly what I start buying. Silver, silver, silver. They are so screwed. I love it. No recession is in sight according to the NBER Recession Index. It's at its lowest level since October of 2020. No recession yet. And that's where I'm going to end it, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys later. This is Finding Value.